In this video, we're going to discuss a couple of important red flags that, if avoided, will keep you out of trouble with the IRS. We are going to see how these red flags got Dr. J, an emergency doctor, in a lot of trouble with the IRS. Dr. J is the protagonist of a May 2023 tax court decision regarding his business expenses. So let's dig right in. The first red flag you need to be aware is that when you file your tax return late or not at all, that can trigger a lot of problems with the IRS. It can trigger an audit or a notice, or it can trigger the IRS to file what it is called an SFR, a substitute for return. This SFR is a return prepared by the IRS in an automated manner, usually about 2 years after the original return would have been due. These SFRs usually are extremely disfavorable and generate huge amounts of taxes, as it happened with Dr. J. Dr. J allegedly didn't file his 2015 tax return, although he claimed that he transmitted a return in August 2018, which would have been late anyway, but the IRS claimed they never got it. Further, Dr. J did not respond to any of the IRS's inquiries regarding his 2015 return. Ignoring the notices did not make the IRS go away. And because they've never heard back from Dr. J, on August 12, 2019, the IRS decided to prepare a substitute for his return for that year based on the 1099 forms that the emergency centers Dr. J worked for reported to the IRS. These 1099 forms from the medical centers showed he made $143,162 in non-employee compensation. And the IRS calculated he owed $59,339 in taxes for that year, which included both income tax and self-employment tax. As you notice, the IRS's calculated tax plus any penalties and interest he owed probably came out to be close to half of what he earned that year. If he had filed his return on time, he could have claimed business expenses and any other allowable deductions, and the amount of tax would have been a lot less. Dr. J, after receiving the notice of deficiency and seeing the huge amount of tax assessed against him, and probably being worried that the IRS will levy his assets, finally prepared and submitted on October 30th, 2019, his 2015 return. He included with his return 2 Schedule C forms for 2 businesses, his medical practice and a film and music business. What do you think the IRS did? Of course, the IRS did not accept or process his 2015 Form 1040. And thus, Dr. J and the IRS got into litigation. Now, Dr. J faced not only the tax, the penalties and the interest, but also representation costs and a lot of scrutiny on what he reported on his 2015 late return. So let's see what happened next. We said that Dr. J reported 2 businesses. And let's start with the first one, the medical practice. These are the expenses that Dr. J claimed on his Schedule C for the medical practice. Dr. J reported $52,599 in expenses for his medical practice, but the IRS only accepted $10,554, disallowing $42,045 based on 2 grounds. Either he did not have any receipts for his expenses, or the expenses were not ordinary and necessary for business. So let's understand what went down here. Documentation, just having bank statements or credit card statements, it's not sufficient. I cannot emphasize enough how important it is to keep receipts and documentation for your business expenses. Credit cards and bank statements do not show all the information about a transaction. You need to have receipts, invoices, contracts, and any other documentation related to that business transaction. In Dr. J's case, the IRS made some concessions in the fact that they allowed some expenses, $10,554 to be exact, of the $52,599 total, based on some partial bank statements Dr. J had. But that doesn't mean they had to do that. This was a compromise on the IRS's part. Now let's look at what it means that the expenses have to be ordinary and necessary for business. For example, Dr. J could not show that his $3,350 in advertising expenses were ordinary and necessary for his medical practice. Why? Well, advertising would not be ordinarily seen done by emergency doctors working as contractors. And when Dr. J was asked why an emergency room doctor would have advertising expenses, Dr. J stated that sometimes you need to promote yourself. Besides the fact that he could not show why this type of expense would be necessary in his medical practice, he also did not offer any testimony regarding how he promoted himself or the source of the reported advertising expenses. In the end, the court held that Dr. J failed to substantiate his purported medical practice business expenses for taxable year 2015, except to the extent conceded by respondent, meaning by the IRS, and disallowed the $42,045 left. Now let's talk about another red flag that can trigger IRS problems. If your business shows losses for a prolonged time after the initial startup phase, this can be a red flag for the IRS, and there is the danger for them to reclassify your activity as a hobby and not consider it a for-profit business. Hobby activities have a very disfavorable tax treatment. Any expenses allowed cannot be more than the income from the hobby activity, and for tax years 2018 through 2025, you pay tax on the hobby gross income without being allowed to reduce that income by your associated expenses, except for the cost of goods sold. Dr. J reported a second business on his 2015 tax return for a film and music activity, let's call it song, for which he showed no income at all, while claiming $104,758 in expenses, all of which was disputed by the IRS on the grounds that Dr. J's a film and music activity was not entered into for profit. The court looked at various factors in determining if his activity was for profit or not, but let me give you some examples of these factors. Dr. J did not have a business plan. He presented no evidence regarding when these activities began, nor precisely what activity occurred in taxable year 2015. His activity was not a licensed business. Dr. J failed to keep complete and accurate books and records. Dr. J presented no evidence on how or whether he abandoned unprofitable techniques in favor of profitable techniques. Dr. J presented no evidence whether he conducted his film and music activity in a manner similar to other activities that are profitable. There was no evidence that Dr. J has ever earned a profit related to his film and music business. The court also found that the recreational or personal elements of his film and music activity outweighed his desire for profit. His losses from this activity generated a substantial tax benefit, because the substantial loss of this activity reduced the income from the medical practice, suggesting, along with all the other factors, that he did not enter into his film and music activity with a profit motive, but maybe as a tax reduction vehicle. In sum, the court agreed with the IRS and found that Dr. J did not engage in songs activities for profit, and therefore he is not entitled to deduct the purported business expenses associated with song for taxable year 2015. In the end, Dr. J lost on almost all accounts, was disallowed almost $147,000 in expenses, and had to pay additional tax, penalties, interest and representation costs. In conclusion, you can avoid a lot of IRS problems by doing simple things like filing your returns on time, responding to IRS, keeping receipts and documents for your expenses, and being reasonable when it comes to the amount of the expenses you are claiming. If you found this information interesting and helpful, make sure to subscribe to our channel.